Lead a life of entrepreneurial freedom with insights from successful creatives, entrepreneurs, and investors. Discover how they overcame challenges and turned their biggest dreams into reality. They share their personal success playbook so you can build the business and life you truly want. Welcome to Passion Millionaire, the podcast by Robert Roth. Rock and roll your dreams.
Welcome to today's Passion Millionaire Podcast episode. Again, super excited. Today we have somebody on that I happened to meet actually just on LinkedIn, doing my daily active business networking, meeting interesting people that are actually building something they are really passionate about. And Hayden, he is very passionate about real estate, and he is running multifamily real estate projects. He's operating those in his Duer Kurami Group. Currently, he personally, combined with the company, has 25 million plus in assets under management. And I think he has a ton of experience already, and he has learned a lot also from his parents and even grandparents, which brings a really great story. So I'm very curious to learn all of those details, how he has started building his real estate business together with his partner to where it is today. And also, I think he has a really great angle, the investors that he's working with. That's a really great angle. I hope you explain how you're doing that, how you offer opportunities to actually invest in multifamily, and you doing all the management, the operations. I think that's a really great thing you have going on, really great business. So welcome, Hayden Duer.
Thank you, Robert. I appreciate that. That was great. Hearing about Mazodashkin. But yeah, no, I really appreciate you having me on. It's been great. I've been very fortunate. As you mentioned, my family has kind of been the catalyst in my my real estate career, and I've been taking on the family portfolio, and on top of that, starting my own portfolio, and so in the growing phase now, and so I'm excited to keep going.
Yeah, super exciting. Maybe let us know a little bit more about that story, how all of that started. Like, I have spotted something like your dad made a pretty big move at one point in his life, and that started changing a lot. So maybe that's a point to learn something about. Let us know how all of that started. I mean, it's a big deal to choose a career like that for yourself, and then, taking on a lot of responsibility.
Yeah. So it started way back, probably in the 70s, 80s with my grandpa, and he was buying some real estate, and my dad took it on in the early 2000s, and he was mainly doing it just to preserve wealth and take care of my grandparents. And in 2006, 2007, he went all in and bought. We're from Northern California, so up in the Sacramento area, we bought single family homes from anywhere from $90,000 up to $200,000, and we're just cash flowing. We were just looking for cash flowing assets, and it really. My dad learned a lot and taught me a lot in that time frame, because his philosophy was, if you're making money from day one and you're cash flowing from day one, it doesn't matter what the values of the real estate do. You own it long term or long enough, values will come back. And as we saw with the crash in '08, the values went down or some of the values went down after he bought them, and then quickly rebounded. But he was cash flowing all along, and he still owns quite a bit of that real estate today. And so a lot of the philosophies that were learned from back in the early 2000s, and even all the way back to the 70s, has kind of been ingrained into me and my philosophy as I go along. So we've just been building for the last 20, 30 years, and now we're at a point where I'm doing my portfolio. So
Yeah, that's a very exciting stories, and I'm happy to hear that he found a good way also to handle those times. And I believe literally what you said, like having the cash flow probably saved him back then, whereas others went belly up. Could imagine that.
yeah.
Yep. And I'd be curious, like, how did you get started with your business? Like, to me, it sounds like that your grandfather got it going, your dad continued, and then did you actually start working with them and kind of grow into their business first and then learned how everything works and then started building out your own at some point, or how did that go?
So no, I actually, when I was right after college, I was talking to my dad, and I originally wanted to be a sports broadcaster, and so I went to school for that. I
Okay.
went I played sports in college, and I went to school for that, and every parent wants to hear that, you went to college and you did not want to do what you've went to college for. So I went to him and said, "Yeah, actually, I don't want to be a sports broadcaster anymore. I want to work in real estate." And uh, so first thing he told me is you got to learn from the ground up. So I actually started in maintenance, and I worked for apartment buildings, in maintenance, fixing things and fixing apartments, and then worked my way up to property management and managed apartment buildings of 150 to plus units. And then decided, you know what, I want to get on the ownership side, and I've learned enough in the property management world to where I feel super confident in being able to operate these types of properties. And so that's what I did, and I started my company a couple years ago. So
Okay, that's very interesting. And also, I'm happy to hear that you literally started from the ground up. I believe that's especially in this, real estate space. I think that is an extremely useful, set of skill that you have probably acquired. Because I could imagine you could look at the building now, and you can immediately spot if the quality of the building is good or not, and you could even spot, okay, what needs to be fixed and how much that would cost, or get at least a rough idea about it pretty quickly. Is that the case, or how would you describe that?
yeah, absolutely. That and rents and what drives rents and what drives tenants and how to keep properties filled. All
Hmm.
of that was learned. One thing that I was taught very early on was get paid to learn. A lot of people pay money to learn and go to school, but get paid to learn. Go
Yep.
and first few, at least for the first few years of your career, go out and get a job where you're learning skills. And the operations and property management skill that I learned has been invaluable in my business so far. So yes, that's absolutely correct. Just learning what makes a property tick and seeing things that some operators can't see has been super helpful.
Oh yeah, I can imagine that. Very interesting also. And maybe I missed that, but what type of properties were those? Was that already multifamily?
Yeah, it was apartment buildings that I was managing,
Apartment
and
building.
yeah, and
Mhm.
my oddly enough, my family doesn't own apartment buildings. We own office space, retail, single family, and I'm now jumping into the multifamily because that was a little bit of my background.
Ah, okay, very interesting. So why did you choose multifamily for your own business?
I understand it in and out, and two, the demand. Everybody needs a place to sleep. I mean, it's the cliche saying, everybody does need a place to sleep, and they always will. And we're all you're hearing in the headlines is, we're undersupplied, our housing is undersupplied, and so I think there's going to forever be a demand for multifamily. So that is why I ultimately jumped headfirst into multifamily.
Hmm. Yeah, makes total sense to me. And the size, I have seen your website, so I can at least estimate the size of the project that you're running. But for everybody who's listening, like, give us an idea of the size of apartment buildings that you're working with, that you have currently under management, and if there's something coming soon, maybe you can also give us an idea about that.
Absolutely. Yeah. So currently we have some smaller projects. We have a 10 unit project that we own, and then starting to grow. We have a 34 unit project, and we are looking anywhere from 40 to about 120 units currently for individual projects. So we're looking in that small to mid size range as we continue to grow and develop kind of our operations and our systems and processes along the way to larger projects. So that's the ultimate end goal, is to be in some of those larger 250 plus unit communities. But right now we're in that 40 to 120 units.
Yeah, that's already a decent size. from what I've heard before, I'm not a real estate professional. I've talked to a couple, right? But sounded to me like that the calculations change quite a bit once you're at the size of somewhere around 40. So the numbers get better for investors. Would you say that's true?
Yeah, so the economies of scale definitely play a huge factor in the types of projects you're looking at, and it really depends on if you're having property management on site. Because if you have property management on site, then you're paying payroll, and that becomes expensive. And so you can have one property manager and one maintenance guy that can operate 40 units, but they can also operate up to about 120 units. So if you're paying the same amount or paying very similar amounts from 40 units to 120 units,
Mhm.
you probably want to be on that higher end to get as much as you can out of it. That's where those economies of scale factor in.
Yeah, that makes sense. Or could you also just have three smaller ones, three with 40 units, and then there's one maintenance guy handling those three, something like that? Or is there a reason why that won't work?
No, that absolutely works, especially if they're in a very close proximity. You could absolutely do that where you're, and a lot of companies do that where they will dominate one specific submarket, and they have, to your point, several properties that are 10 to 40 units where they can separate those costs, which is great.
Hmm. Yeah, and why would there's a lot of people interested in doing real estate, right? Investing in real estate, as you already said, preserving wealth, right, and then also expanding wealth. And
Mhm.
real estate is more of a long-term game, right? It's not the quick buck. I mean, it could be if you're flipping real estate, but that's a different topic to talk about, I guess, at least to my understanding.
Mhm.
What you are doing, that's really long-term build out projects, and that's long-term money expansion, cash flow expansion. So I'm curious, like if people, professionals that have money and they want to invest in real estate, why would they work with someone like you, right? You're bringing those projects and operating them versus just going ahead and doing it by themselves.
Yeah, it's a good question. And a lot of people that are deciding that whether they want to go and buy a couple of single family homes versus just putting their money more in passive real estate is one, it's a lot of effort, a lot of energy. And in the single family side, it takes a lot of, on top of that, it takes a lot of experience and it takes a lot of knowledge to get into the larger, apartment buildings or mid-sized apartment buildings.
Hmm.
So if you have the time, energy, and effort, absolutely, more power to you. But if you're starting in the single family space to get some knowledge, that's great. It's going to take some time, energy, and effort while you're running your day to day life and your W-2 or your
Hmm.
day to day business, what have you. It's the difference is investing in something like what we provide is more of a passive investment. You get every benefit of the real estate. You get the equity, so the appreciation. You get the tax benefits. You get the cash flow. You can in commercial real estate. There's massive tax benefits that come along with it, and so that is ultimately while you're learning. And on top of that, you can learn from what we're doing because we send out updates, we work with our investors, we talk with our investors, and a lot of our investors learn from what we are doing personally and what we're doing within our business, so that if you do decide to do it, you can build off of that knowledge and understand what an investment like a multifamily investment really takes, or just real estate investment in general really takes.
Hmm. Okay, yeah, that's a quite interesting point. Also, I mean, it's a lot of knowledge. So basically, you're also saying, I mean, you will make more mistakes if you have never done it before versus somebody who is doing this in his, everyday life. And
Yeah.
yeah, that makes total sense to me. Also, what I find quite interesting that when you own a part of a project, and that you can also have part of the depreciation. Or
Hmm.
that's something I never really thought about, but it makes total sense. The big advantage. Like, who would typically go ahead and invest with you? And what would be the typical amount somebody would invest with you? And maybe let's start there and then I have more questions about that.
Yeah, so we typically are in the smaller range. We're in the $25,000 to $50,000 range for an investment. A lot of people think you need hundreds of thousands, if not millions, to get started in a real estate, and that's not necessarily true. So, the $25,000 to $50,000 range will get you an ownership stake in a 30, 40, 50 plus unit apartment building. And yes, that's true. You do get the trickle down of the depreciation and all of the tax benefits that come along with it, the write-offs that come along with it, passed down to our investors.
Yeah, quite interesting. And I'd be super curious. I mean, when you started your own business out in the first place, like, was that an easy thing to do? Or was there some challenges that you had to overcome? Because that's something every business owner kind of faces. Maybe there are some tiny exceptions, and there's always learnings in that. Like, if you had challenges along the way, no matter if that was in the very beginning or somewhere along the way to where you're at now, like, what was your biggest challenge and how did you overcome it?
Yeah, biggest challenge is how long it truly does take to build and grow a real estate company.
Hmm.
That's just having patience and as I mentioned, my background, or I mean, I played sports growing up and played sports in college, and uh, learning from baseball in particular, learning from baseball that you can fail X amount of times. You can fail 7 out of 10 times and still be considered great.
Hmm.
And taking that learning into business and into real estate in general, and keeping that level head has been a super, or has been a massive advantage, and it's kept me even keel where there's not these huge emotional swings, because it certainly can happen. One day you're on cloud nine, and the next day, the carpet can be ripped underneath you, as many people can in many different industries can relate to that.
Hmm.
So that's kind of I'd say the biggest lesson and the biggest challenge, and the lessons that I've learned is um, it's going to take longer, and it's going to take a lot more patience than you ever thought, and a lot more massive action than you ever thought was needed. It sounds so easy and so conceptually not easy, but it sounds so conceptually logical. Hey, this is what I'm going to do, and these are my goals, and this is what I'm going to hit. But
Hmm.
the practical application of it is much more difficult than you anticipate. But
Yeah, and especially, like, how did you pull your first project off?
a lot of work. Yeah, it took a long time. Uh, I actually started working with a mentor, and he taught me exactly how to get started. And what I did was, first I found the market that I wanted to invest in, or a couple of markets that I wanted to invest in, and then I started hitting the phones and calling brokers, setting up my team in the market. So I spent 3 to 6 months setting up my team, my property management, my contractors, and my brokers, so on and so forth,
Hmm.
setting the team up, and also talking with brokers and understanding, letting them know that I am serious and I'm looking to buy and I can close. And it's a lot harder when you have never closed to say, or to prove to a broker or to a lender, a
Hmm.
team, that you can and will close, right? Because you're still raising the capital, you're still, you still have to underwrite the project properly, and so on and so forth. So that was a huge challenge to start, but getting into that first project, just
Hmm.
massive action, and calling brokers on a weekly basis, bugging the heck out of them, letting them know that I'm ready to buy, and buy as soon as possible.
Hmm. That's
Yeah.
interesting. So calling all the brokers, that's one end of the stick, right? And the other end of the stick is also, as you already mentioned, you need to bring up the money to actually make the deal happen. So how did you find the investors for this first project? I mean, especially it's a first project. So people need to find enough reasons to trust you with their hard-earned money.
Yeah, absolutely. And it first started with what types of returns are investors going to be attracted with, and making sure that your underwriting matches or beats those types of returns. And then it's, the confidence in your ability to execute. And, my partner and I are very similar in the fact that we would never take a dollar from an investor if we didn't feel 100% confident in our ability to execute our plan and invest our own money into the project.
Mhm.
And so first we started with friends and family, and that's a massive ask to ask friends and family and people you grew up with and to trust you with their hard-earned dollars. And so for us, that's kind of where we got started, was friends and family. Our first capital raise, we had to raise $650,000,
Yeah,
and
that's quite a chunk of money, right?
yeah, and 7 days before we close, we had we had everything ready to go. We had all capital raised, and we had some people back out at the last minute. We lost
Oh,
$250,000 within
ooh,
7 days before closing. So that was a little, we lost some sleep, I'll say, to say the
wow.
least. Uh,
Why did they back out, and how did you fix that?
yeah, yeah. I mean, just normal, normal things. Just hey, I'm not confident or comfortable in this, and it's your first
Mhm.
time, sort of
Yep.
things. They didn't necessarily say that, but you definitely could get that sense. And so, but overcoming that, just having more investors and reaching out and starting before we needed it was huge. Starting to educate, starting to talk about what we're doing before we had the opportunity was invaluable in that time, especially. So we had some investors that we went back to and spoke with, and they ended up putting some money in and closing. And then we closed and still had to raise a little bit, but yeah, it was a stressful time, but it was worth it, and learned a lot.
I could imagine that. Wow, that's quite interesting. So, how many investors did you have to find to fill that $250,000 gap?
That was about 5 investors towards the
Yeah.
end.
Okay.
Overall, we had 17 investors invest, and those were some
Uh,
smaller amounts. So that in that
Yep.
25 to $50,000 range, we had most of our investors. So
Yeah, and the 250,000, like that was five investors that kind of jumped off, or
exactly. Yep.
exactly five. Okay. Wow. I mean, that's yeah, quite a challenge, literally, and I'm happy you overcame it. And
Yeah.
I think you said something really smart there. I mean, it sounded like you were prepared, like you had educated people, and you found people out of that pool basically that then were able to trust you and fill the gap.
Yes. Yeah.
Okay,
Absolutely.
that's amazing. I mean,
Yeah.
you have done a lot of things right there, and that the first project is the hardest one. I think I could imagine the second one was a bit easier because that reason is gone, right? I mean, it's your first project; nobody can say that anymore, right? You have one
Yeah.
going.
Yeah, similar challenges, but easier to overcome because we went through it.
Yep.
uh, and we did have still some skepticism, but a lot less. And we that raise was proved to be significantly, I don't want to say easier because it was tough, but significantly easier than the first one.
Okay. Yeah. Quite interesting. And mm, so you have two multifamily projects under management currently in your company, right? Plus you have some where you invested personally. That's what I understood.
Absolutely,
And
yeah.
there's the next one is already coming, I assume. Next
Yes.
project.
Yeah. Yeah,
And
we're in negotiations on a couple different projects, and
okay,
this one is uh,
that's a bigger one already.
yeah,
Or
yeah. We're looking in that 40 to, like I said, 40 to 120 units, but the few that we're looking at is in that 40 to 70 unit right now.
okay, yeah. So how much money would you have to raise then there? I assume you're looking for properties again in California in this case.
No, so our
Oh,
properties are all
okay.
out of state. All out of state. We own a project in uh, Arizona, and we own a project in Kansas City. So,
Mhm.
um, yeah, so it's all over. And the reason we felt comfortable with doing that is in my asset management, property management, a lot of my or everything I manage is out of my local market, and so I'm super confident in being able to build out a team, and my team has been amazing that we've worked with in a few of these markets, and hats off to them. They've done a great job and more than or done a better job than I even anticipated, and so yeah, that's so everything's been out of state. So it's similar. We're in Kansas City, Missouri is one of our markets that we own, and we're still looking to grow, and so yeah, that's where our next one would be.
Oh, okay, interesting. And so what's the amount of money roughly you think you have to raise for that project?
So these next projects are anywhere from 1 to 2.5 million that we're looking
Okay.
at. So still, relatively from what we're accustomed to is a little bit larger, but overall, a very manageable raise.
Yeah, and if somebody would invest in a project, maybe let's go back to your existing projects, because like that exists. Those are, not only financed, those are running, those are managed. Let's say one investor has put $50,000 into that project.
Mm-hmm.
So what is the return out of
Yeah.
that?
Yeah, so we typically target on a cash flow basis or on a cash on cash return basis,
Hmm.
on average, anywhere from 7 to 10%.
Hmm.
And on a overall return we typically hold these projects anywhere from 4 to 7 years. So there's a time frame. We give a typical of a 2-year time frame when we're looking at these projects. It'll be 4 to 6 year hold, or 3
And
to
you
5
want to
year
sell
hold.
them, flip them, or
Exactly. Yeah. So we're looking
okay,
we're looking to have some runway where we can improve the property, increase rents, optimize all of the operations, and then go and sell anywhere from that 4 to 7 year time frame. And
okay.
so to answer your question, yeah, we're typically looking to 2x or better the overall investment, from cash flow to appreciation, and so on. That's not including any of the tax benefits that
Mhm.
are in there. So
Okay, that's quite interesting detail to know, because I was assuming you're acquiring those projects and then basically holding them, managing them forever and just cash flow. But okay, no, different approach. And I mean, that's a matter of preference, I guess, for the investors, which one they would be looking for. But I think that can be a pretty profitable approach. So I'm wondering also, when you collect the money from investors for a project,
mhm.
is there already the budget included for all of the improvements of the project, and you have that on the account and you're using that, or do you actually need to raise extra money to do that?
Yeah, so everything that you raise is included. So you're paying for, the investors are investing the down payment for the loan. They're investing the renovation budget and the closing costs.
Mhm.
So those three things are what they are, or what their money is going towards. And
Mhm.
for that, we have the overall returns throughout the project that are baked into those to those buckets. It's not as if certain investors have the down payment, or invest in the down payment. Certain investors invest for the renovation. It's just all encompassing. We're looking for example $1 million. That investment comes, or those, we invest $1 million, or we have $1 million that we raise, and we're looking to take that $1 million and give back 2 million or more to our investors throughout, or their money back plus another $1 million throughout the investment.
Mhm. Okay, very interesting. And then when you say 7 or 8%, that will be return per year. What happens when the project is being sold? And let's say it's been sold for 2x. So would that also mean if I have put in 50K, then I open my my bank account for you and I'm receiving 100 now, or how does that look like?
Yeah, it's a great question. So throughout the project, you're getting cash flow, that's 7 to 10%. So if you're investing $50,000 and it's a 7% return, on average for that hold period, let's say it's 5 years, on average, you'll be getting or returning $2,500 in cash flow every, no, that's not correct. $3,500, excuse me, per year in cash flow. And then that's included in the doubling of your capital. So the equity takes care of the rest. So when we go to sell, let's say we've returned $25,000 in cash flow over the investment. You will get your money back plus an additional $25,000. That's what we're assuming in the 2x. It's not an exact science, or it's not an exact. We're only going to give back $100,000 to you, but that's what we're aiming for. What our target is at least doubling your money, if not better.
Okay, interesting. It kind of sounds like, though, that there is kind of a baked-in, pretty big equity stake for you on that upside, in case you sell it, or as the operator.
Yes. So how it works is we give back, it's called a preferred return. We give back a preferred return, which is basically the first dollars that each year that the property makes goes to our investors. So for example, our preferred return would be 7%. The first 7% every year goes back to our investors. And then there's a split after that. So it's a waterfall split is what it's called. So for example, if the split is a 75-25 split, the first of every $100, the first $7 goes back to the investor. And then everything after that is split 75 to the investors, 25 to the operator.
Okay. So basically you have, out of a sale, you have 25%. Am I getting that right? Kind of?
After you give back the 7% annual preferred return. Yes. Yes.
Okay.
So if we don't, for example, we're renovating these units, we might not be able to hit 7% cash on cash return in our first year or 2 years, but it's all accrued. So 7% every year for say 5 years goes back to the investor first. Once we catch that up, then every dollar made on top of that is split 75-25. Does that make sense?
Okay. Yeah, it does make sense. Yeah, quite interesting concept. Yep. So basically, as the return goes back to the investor first, the first 7%, also yearly, it means they have less risk than you in case, there's less money being made. That's how it sounds like to me. So you have more risk, but also at the end, you have that upside of about 25% once the sales happens, which is a nice chunk of return for you.
Yeah,
does it kind of make sense?
Yeah, exactly. And it's like like an interest rate, for example.
Yeah,
it's like an interest rate for your money. It's not that we're guaranteeing the 7%. It's just the first 7% goes back to the investors.
Yeah, quite interesting. And typically, like, how much would that make per year? Like, I mean, you know your current projects, and then maybe you can average it out or so just to get a basic idea in percentage per year.
You're saying so? Or can you
what's the annual return on average throughout those 2 projects? Per year.
So the average annual return is anywhere from 17 to 20+% on a return, on an average annualized return. And one metric that multifamily or commercial investors look at, or they consider, they factor in, is the IRR, which is the internal rate of return, which basically is the annual rate of return that factors in inflation or the time cost of money. So the IRR, you're looking for somewhere in the mid-teens, somewhere between 14 to 16+%, at least for your investors.
Yep. So that would mean, it does make sense. So basically, let's say it's 14 IRR, then the first 7% goes to the investor, and then the other 7%, they would be split 75-25. So does that also count for that?
Of the annualized return. So of that first 18, so if that, let's say the annualized return is 18%. That's correct. The first 7% would go to the investor, but it's broken out. when you sell, that's really when you're getting the bulk of your returns, when you're getting the equity.
Yeah.
But yeah, that's kind of how it's broken out. Average, that first 7% will go to the investors, and then the next, what is that? 12%? No, 11%. Excuse me. 11% would be split.
Agreed. Whoa, but now we were in the really deep waters of numbers. But
Yeah,
thanks
sure.
for that, because that's very, very insightful. Because like, I'm just assuming, okay, if I would make an investment with you,
Mhm.
what happens to my money, right? And how does the return look like? What's the risk? And then at least what we've just talked about, like, gives a basic idea about all of that. And
Yeah.
I'm assuming those are kind of the conversations, maybe also with the investors that you're taking on. Or what would be the most typical question that you're receiving from somebody who is interested in investing with you before they decide to do so?
Yeah, it's a great question. A lot of what I a lot of questions that I get is experience
Hmm.
and and kind of the questions on the market in general. Not as many people say, "Hey, this particular project," they're not getting as granular as what's going on in this particular project. I mean, we do get into that, but the major questions before we can even talk about an investment is, what's your experience and why did you choose this particular market, and kind of the market knowledge. So they're wondering what my knowledge is on the market and where I see the market going. Those are the main first couple of hurdles that we talk about with investors,
Hmm.
at least in my experience.
Yeah, that's what I was wondering about. Makes
Yeah.
total sense to me. I can see that. And is it the way you choose the properties you're looking to invest in? Like, you're doing that by yourself together with your partner, or is there even potentially more experienced outside partners that help you make the right decision there, or how are you handling that?
Yeah, myself and my partner, we've done a lot of research, countless hours of research on market trends, what we like about certain markets, and also how that fits our investment style and our thesis. We like cash flow heavy markets, so we're going to look at what we view as the best cash flow heavy markets that's within uh, physical or geographic, relevance to us. So we're, like I said, I'm in California, and my investments are in Arizona, Texas, and Missouri. So that's, it's a short 2 to 3 hour flight, 1 to 3 hour flight for those markets. So we can get there in a day's, within a day if necessary. So that's kind of today what we're looking at. And then on top of that, all of the how the market matches our investment thesis.
Hmm. Okay, yeah, that makes total sense to me. So definitely, you're also getting out to those projects. I mean, for sure, before you're buying that, I'm assuming you go in there and check out if the
Yeah,
water
yeah.
works and, and
Yesterday,
all of that.
yeah, yesterday my partner was in Tucson, Arizona, where it was 100 degrees, and then he
Yeah.
flew out or Monday, he was in Tucson, Arizona, it was 100 degrees, then he flew out to Kansas City and it was snowing. And then he came
Oh,
back to California and it was 75 degrees. So
wow.
he's a body shock.
Yeah, it sounds like it. Okay,
Yeah.
so how many actually are you? How many properties are you physically going to checking out before you make a decision? Are you seeing like 20? Are you seeing 10? I mean, beforehand, of course, internet research and all of that, phone
Yeah.
calls. That's at least the idea I have. But literally going there, checking them out physically. How many would that be?
Yeah, it's a good question. So we typically will underwrite. So for example, so far this year, we've underwritten around 80 properties. We
Oh,
have,
wow,
yeah, we
a lot.
have submitted about 12 offers so
Hmm.
far this year, and we've seen probably about anywhere from 18 to 20 properties throughout those two markets, because we're going there every week, every month, to check our properties, uh,
Hmm.
our current properties. We're going to these markets and we are viewing these properties and viewing other properties that we're interested in, and so that's kind of how it's been working out. So yeah, it's I hope that answers your question.
Yeah, 100%. Yeah, super, super interesting to learn that from you also. That to me, that sounds like it makes a lot of sense. I'd be happy if somebody who is listening right now, or maybe whenever later after we've recorded this episode, if somebody's interested and thinks like, okay, Hayden, he's somebody who's really after this and knows what he's doing and has money, is interested in investing in real estate and at least want to have a chat with you, what would be the best way to get in contact with you, Hayden?
Yeah. So I'm active on, as you mentioned, active on LinkedIn. So my first and last name on LinkedIn, Hayden Duer. And I'm also active on Instagram and my website as well. So the Duer Kurami Group.com is my website. So anywhere there, I will absolutely field calls and field questions.
Yeah, sounds great. We also making sure to have this in the show notes, so it's an easy click away to get in touch with you. Last question. What do you think in your field of real estate and the investors you're working with, if they would do it by themselves, those investors, what do you think would be the biggest mistake they typically would make?
So the investor, you're asking if the investors
would go out and
want to go and buy,
do a project, by themselves.
Just really understand the numbers. If you're looking at a project and it cash flows, your mortgage is $1,000 and your rent is $1,300, that doesn't necessarily mean you're going to be cash flowing $300. So making sure you understand the numbers and what the true and accurate expenses are. I've seen a lot of people who will get into projects and they'll say, this project's great. I'm going to be, 10% return. I'm going to be cash flowing, $500 or what have you per month. And it doesn't turn out to be that way because you have maintenance, you have repairs, you have big expenses that people don't necessarily factor in. So definitely factor that in.
Yeah, makes total sense. Appreciate you saying that and leaving us with that. Hayden, again, thank you so much for hopping on. See you soon.
Robert, it's been great. Thanks so much for having me.
Go to rockandrollyourdreams.com/podcast.